Thank you, Tiffany. Good morning, everyone, and thank you very much for joining this session today. As a brief introduction, my name's Edward Kennan, and I'm a Corporate Hedging Manager here at Western Union Business Solutions. I'm very pleased to be presenting this morning's webinar, focusing on a market outlook and risk management strategies for your foreign exchange exposure. I think we could all agree that it's a crucial time to be addressing these two topics in light of the current unprecedented economic environment that we find ourselves in. Just last month, it was reported that the US unemployment rate jumped to almost 15%. This was after it was sitting at a 15-year low back in February. Additionally, it was also reported that 20.5 million jobs were lost in the US alone in April. Now, while stock markets have rebounded strongly from the March lows, the key unknown from here that remains is whether or not we will in fact see a V-shaped recovery, a fast recovery, or whether the economic hangover will last for many years to come. I'd just like to highlight here that throughout the presentation, should you have any questions, please feel free to post these via the Q&A icon below. So I'll start with a global macroeconomic update. So the IMF was hopeful going into 2020 for global growth, and they had good reason to be. According to a CNBC report, hotel construction activity had never been busier. Airline employment globally had been growing at the fastest pace for more than 16 years. In the US, in December of 2019, retail sales had risen for the third straight month. And for 2019 as a whole, US consumer spending had risen to a record level of more than 13 trillion. So at worst, the IMF was expecting a tentative stabilisation in some regions and a sluggish recovery in others. The US was expected to slow marginally to 2% year-on-year growth this year, down from 2.3% in 2019. But the slack here was expected to be more than picked up by the regions in Latin America, the Middle East, and Asia. Overall, the IMF was expecting global growth to increase to 3.3% this year, up from the 2019 estimate of 2.9%, which wasn't bad. So it was looking as though Donald Trump was going to be granted his election wish of a strong stock market and reasonable global growth going into the US elections in November of this year. And then coronavirus happened. So as we're all aware, the coronavirus outbreak and subsequent spread has changed everything. What started as a problem in China quickly spread to other parts of Asia and then to Europe. The most significantly impacted countries initially outside of Asia were Iran and Italy, but as we can see on the map here, no country or region has been left spared the impact of the COVID-19 pandemic. Hardest hit has been the United States, with literally millions of cases reported so far. So the impact of the COVID-19 pandemic has been far beyond the worst case scenarios that any business owners could have been prepared for. Instead of a gradual slowdown in economic activity, the coronavirus and the efforts to contain it with all these lockdowns has pretty much ground the global economy to a complete halt. Now, this chart here illustrates the actual impact on global growth. It's a chart of quarterly GDP. So what's firstly most noticeable here is how much worse the current situation is in terms of a drop-off in growth when compared to the most recent economic downturn, the recession that we saw in 2008 from the global financial crisis. So in 2008, we saw global growth drop to levels in the vicinity of 2% in consecutive quarters. So that was an economic contraction quarter on quarter of 2%, which obviously was a very deep contraction. What we've seen in the first quarter this year, however, is even worse. The economic contraction is estimated to have been in the vicinity of 3%. And in the current quarter, it's expected to be even worse, in the vicinity of 4 to 4.5%, which is twice the level that we saw back in the very deep recession of 2008. What's also notable here on this chart is the blue bars, which illustrate China's quarter-on-quarter growth we can see that China had a much worse first quarter than the developed economies. The developed economies such as the US, Europe and Japan are depicted by the yellow bars here. However, in the current quarter, which is expected to be the worst on record for developed economies, China is actually expected to return to a positive quarter-on-quarter growth. And that's just by nature of the fact that their economy was closed down earlier. They were the first country to lock down, and they've since been able to reopen their economies well before developed markets have. Another interesting comparison to 2008 is addressing the severity in terms of the sudden impact of the economic shock. So back in 2008, the global financial crisis, the slowing of the global economy actually started in late 2007, where it was apparent that a liquidity crisis was emerging. It was becoming obvious that asset prices were overvalued and there was too much leverage in the financial system. This caused a gradual slowing of the economy that bottomed out towards the end of 2008. However, we can see that the recovery towards trendline GDP growth, the trend that was happening for growth prior to the economic shock, the recovery took a long time due to the deleveraging of the financial system. So there was a period of very slow growth for years following the global financial crisis, and this created a GDP shortfall from trend that lasted for a long time. So this time's expected to be different. Firstly, by nature of the fact that the GDP dropout has been front-loaded. It's been very sharp and sudden due to all of these economic lockdowns. However, the recovery once the lockdowns are lifted is expected to be quite fast compared to 2008, as shown by the BlackRock report here. So it hasn't been due to any problems in the financial system, not an excess of leverage, no toxic assets like we saw in 2008. Rather, this has been a self-imposed lockdown by governments, which effectively has locked down economies as well. However, the reopening of economies combined with coordinated policy responses from global central banks, injecting billions into financial systems. This is expected to facilitate a much faster recovery to pre-crisis trend growth. Now, there are a number of risks to this scenario. Firstly, a second outbreak of coronavirus could cause economies to shut down again. And secondly, consumer spending habits are a big unknown following the lifting of the restrictions as well. So for example, it's widely expected that travel won't be returning to the pre-crisis levels anywhere within the next 24 to 36 months. So in terms of the impact of lockdowns, this chart here shows just how much of the global economy is still in lockdown, whether a full lockdown or a partial lockdown. So we can see here that China, which represents approximately 16% of the global economy, their lockdown's now effectively in the past. Their restrictions have largely been lifted. However, the rest of the developed economies and much of the emerging economies are still very much in lockdown. So that includes the US, Europe, as well as other countries such as Australia and Japan. So with 63% of the global economy in lockdown, that very much prevents people from being able to go out and spend, from travel. Aside from the essential items such as food, pharmaceuticals, and medical supplies, the rest of the economy has pretty much fallen off a cliff, and that will remain that way until we get a reasonable portion of this 63% in lockdown being able to return to normal activities. So when will the lockdowns end? Well, this chart provides an indication based on China's experience and assuming a mid-March start date. It's also taking into account measures that governments have implemented and broadcast in terms of when economies and restrictions may be lifted. So whilst we're aware that some of this data has been pushed out, Singapore, for example, we're all aware that there'll be partial restrictions lifted at the start of June, but it will probably be towards the end of June that we see more of the economies being reopened. And that's the case for a lot of these countries. We know now that the UK won't be opening very likely until the end of the current quarter. However, most analysis is still predicting that restrictions will be lifted either partially or fully by the end of the second quarter. And that does set up the global economy for potentially a significant rebound in the third quarter. So this chart here is an indication of how quickly economies may return to something close to full speed. So what these lines are showing here is the coal consumption of 6 of the largest power producers in China over the past few years and including this year. So the 2 grey lines and the yellow line show the consumption in 2017, 18 and 19, whereas the black line is the consumption for 2020. So what's obvious in all 4 years is that power consumption does bottom out over the Chinese New Year holiday period. In the previous 3 years, we can see that consumption increases steadily within the first 20 to 30 days following Chinese New Year before plateauing. However, this year has been very different. It just happened to be that Chinese New Year was the time when the lockdowns were imposed in China. And we can see that as a result, it's taken the power consumption a very long time to return to anywhere near it was in the previous 3 years. In fact, even after 70 days, so 70 days since the lockdowns were imposed, power consumption's only returned to about 80% of what it was in the previous 3 years. So that's a reasonable indication that it will likely take between 2.5 to 3 months before economies can return to around 80% of capacity following the start of a lockdown. To return to 100% of capacity will very likely take several months more. We heard the US Federal Reserve Chairman Jerome Powell say on the weekend that he doesn't believe the US economy will return to 100% of pre-crisis capacity before a vaccine is readily available. So looking further ahead past this quarter, we can see from the Oxford economic analysis here that there is a significant rebound expected in the third quarter. So whilst the economic contraction, the quarter-on-quarter growth is expected to bottom out this year, this quarter in the vicinity of 4%, a steep increase to pre-crisis or above pre-crisis levels is expected in the third quarter. That's then expected to taper off in mid to late 2021. Now, whilst this does show expectations of a V-shaped recovery in economic activity, it's important to note that there are several risks to this scenario. So, for example, a second wave of coronavirus may force governments to shut down parts of their economies again. We've seen that over the past week in China, where one of the provinces has been shut down again due to a small number of outbreaks. So something like that could create a more U-shaped recovery rather than a V-shaped recovery. In addition to that, it's a great unknown what people's spending patterns will look like following the easing of all these restrictions. So even if people have the freedom to go and travel and spend just as before the crisis, there may be cases of people wanting to instead be more conservative, given the economic shock and the prospect of job losses that we've seen over the past few months. So that's probably the biggest risk to a speedy recovery or a V-shaped recovery. So in summarising the macroeconomic conclusion, the global economy is currently in a recession. In the first half of this year, we've seen far bigger falls in economic activity than we saw during the global financial crisis in 2008. But as these lockdowns are eased and eventually removed, we do expect to see a big bounce in economic activity. Nonetheless, we are sceptical that activity can return to its pre-crisis path within the third quarter. That would be very much a V-shaped recovery, Whilst possible, there are several risks, as highlighted earlier, in terms of a second wave of coronavirus and also consumers changing their habits once the economies are reopened again. I'll now move on to an FX update. So before I go into detail on the forecasts for the particular currency pairs, I'd firstly like to provide an overview of how foreign exchange markets are tied to the global economic cycle. So in times of economic downturn, such as in 2008 and in the current environment that we're seeing with a lot of uncertainty, safe haven currencies in the US dollar, the Japanese yen, and the Swiss franc outperform. So during times of stress, this has typically always been the case. If we look back at 2008, the global financial crisis, 1999, the tech wreck, 1987, the Black Monday crash, the safe haven currencies always outperform during these times. On the flip side, the risk-sensitive currencies, such as the Australian and New Zealand dollars and emerging market currencies, perform better as economic confidence improves. So when the global economy is recovering from these economic shocks and crises, these currencies typically outperform because historically they're higher yielding currencies and investors are willing to take more risk in order to achieve the higher yield. The Singapore dollar is somewhere in the middle. So whilst it's not typically a high yielding currency, it's certainly not a safe haven currency either. It's very much tied to global growth, given the Singapore economy is such a trade dependent economy. And it has been pressured this year as equity markets have fallen, because that obviously does impact global trade. It's also been impacted by the fall in oil prices, given that a lot of industry in Singapore is tied to the oil and gas industry. So whilst we've seen the Singapore dollar weaken against the US dollar so far this year, this can be reversed if the global economy recovers. So if we see stock markets recover, economic activity get back to pre-crisis trend, that will obviously improve global trade as well. And in that case, it's possible that we could see the US dollar weaken against the Singapore dollar. So moving on to the actual analysis of the currency pairs, what we can see here is that there has been more or less a 10-year uptrend for the US dollar against the Singapore dollar. There's major resistance up at 145 that did get reached briefly back in March of this year, but the safe haven appeal has been key to support the US dollar, and that's what we've seen so far since February this year. Although it has come up a long way from the levels we saw in January, down just below 135, it's important to note that the dollar Sing did hit a high of 156 during the global financial crisis in 2008. So it's come up a long way, but that's not to say it can't go higher. Our forecast from our APAC currency strategist, who's based in Australia, is for the dollar Sing to reach a level of 1.5 over the next 12 months. However, the Reuters forecasts, the most recent polls, which surveys between 13 and 15 global banks, the consensus is a bit lower at 141. In terms of the Euro Sing, we can see that this has been in somewhat of a downtrend for the last decade, and this is largely due to the policies by the European Central Bank, which has driven their interest rates further into negative territory, in particular over the past few years. On the upside, there's major resistance up at 1.65, and our strategist's forecast is for it to rise slightly higher than this over the next 12 months at 168. The Reuters forecast is also for the Euro Sing to trade higher than the current levels, the current spot market, but nonetheless lower than the Western Union forecast at 159.33. So the Japanese yen against the Sing has been strengthening this year, and that's again largely due to the fact that the Japanese yen is a safe haven currency and has appreciated against all global currencies. So major resistance is seen on the upside at 1.38, and any more shocks to the global economy may see this pair move even higher. The Western Union forecast for the next 12 months is at 142. However, the current Reuters forecast consensus is for it to be slightly lower than current market at 1.3056. So the Singapore dollar against the Chinese yuan has been extremely volatile over the past decade. Typically, this currency pair is driven by moves in the Singapore dollar, given the fact that the Chinese yuan has historically been pegged against the US dollar in a particular bandwidth. However, this linkage is lessening as the yuan becomes a more independently and freely traded currency. So trade issues have largely taken a back seat in terms of the US-China trade war reaching a phase 1 deal. There has been some more rhetoric recently with Trump blaming China for the coronavirus outbreak. So some trade tensions are still simmering, but definitely not the levels that we saw last year. Many analysts also don't think that China will deliberately devalue their currency, as it will be politically problematic and could reignite another phase of a trade war. In terms of the Sing Yuan currency pair, the Western Union forecast is for it to trade significantly lower than current levels, around 5, down to 4.75 over the next 12 months. The Reuters forecast is also for this pair to trade lower over the next 12 months, down at 4.9574. The sterling Sing, much like the Euro Sing, has also been in a significant downtrend, in fact, since the 1980s. So the Brexit fears have been resolved. The UK seem to have their political situation somewhat more stable. However, the UK-European Union trade deal is the next concern. The current Western Union forecast for 12 months is for this pair to move lower than current spot, down to 1.7. However, the Reuters FX polls are forecasting for the pair to move higher than current spot, up to 1.8118. So this is definitely expected to be one of the more volatile currency pairs, just given how much uncertainty there is surrounding the final negotiations around Brexit and in particular, the trade deal with the European Union. So lastly, we'd just like to discuss the Reuters FX poll for dollar Sing and how these are presented. So we can see from the mean here, the mean of I believe there's 13 forecasters or contributors in the past in this poll. The mean is for dollar Sing to move to 141 over the next 12 months, which is slightly lower than the current spot market. The lowest, almost bearish forecast is by Julius Baer, the Swiss bank. They're forecasting dollar Sing to be down at 135 in the next 12 months. On the flip side, the highest forecast is from Barclays Bank. They're expecting dollar Sing to rise up to 149 over the next 12 months. So there is a significant bandwidth in terms of contributions, with the median being at 141. So we've discussed up until now how there is unprecedented levels of uncertainty in global financial markets currently. And this is very likely to result in heightened volatility for the remainder of this year and well into next year. However, rather than fearing such volatility, anyone with foreign exchange exposure within their businesses should be abundantly aware that these risks can be simplified and managed accordingly via appropriate hedging solutions. So I'll start with a risk management overview of how we approach hedging here at Western Union. So we always break down the hedging process into 3 steps: the why, the how, and the what. So why do our customers hedge? How do they put in place and formulate strategies to hedge? and what tools do they use to execute these strategies in terms of product selection. So when it comes to hedging, we always start with the why. Why are our customers hedging? First and foremost, this is to protect gross margin. So hedging helps to ensure that gross margin is protected against adverse exchange rate moves, and this is essential for long-term profitability. Cash flow certainty is also crucial as a positive result of hedging. So certainty of cash flows allows for future plans to be executed without the need to borrow or to dip into working capital. And concentration on business is also crucial. So this, by having a risk management strategy and plan in place, this frees up time as a business owner to concentrate on more important activities such as increasing sales, bringing new products to market, and maximising profits, instead of worrying about what foreign exchange markets are doing. So I'd like to go through an example for gross margin certainty and how important it is to be considering risk management strategies, in particular in volatile markets that we've seen recently, where the percentage moves this year alone have been significant. So in this example, we're considering an importer based in Singapore, ABC Imports. In the first year of operation, they have sales of 10 million Singapore dollars. Their cost of goods sold, which is imported from overseas, costs $8 million in Singapore dollar terms. So as a result, they've returned a gross profit of $2 million. They also have fixed expenses in Singapore totaling $1.4 million. So that leaves a net profit of $600,000 in the first year. But what happens if there's a 10% depreciation in the value of the Singapore dollar? Well, in the following year, we'll assume that sales are the same, 10 million Singapore dollars, but the cost of goods sold will increase by 10% due to the fact that there's been a depreciation of 10% in the Singapore dollar. That means the gross profit reduces to 1.2 million. Fixed expenses, we're assuming, are the same at 1.4 million, meaning a net loss of 200,000. So that's a stark turnaround from a $600,000 profit to a $200,000 loss. And it should be pointed out that a situation like this can be so easily avoided even via the most straightforward hedging strategies. So what happens now? Well, the importer can accept the gross margin decrease and hope that foreign currency markets turn around. They can increase prices, but of course this may result in their products no longer being competitive. They could also dip into working capital, borrow, or attack the expense line, lay off staff or shelve expansion plans, but none of these are ideal for long-term growth and profitability. So this really does highlight the importance of being able to address and manage foreign exchange risks accordingly. So in terms of another example of gross margin certainty, I'd like to go through an example with a commonly used strategy in the budgeted rate, or the target rate as it's also known. So here we'll assume another importer, a pen importer based in Singapore, and they import their pens at a cost of $100 a unit. They're very confident they can sell the pens at a price of 180 Singapore dollars. And they'd like to achieve a gross margin of 20%. So that means they'd like to make a profit of at least 30 Singapore dollars per pen. In order to do that, they need to be paying no more than $150 per pen. So if they're importing the units at $100 per unit, they need to make sure that they're protecting a US dollar against Singapore dollar rate of 1.5. Now, if they can achieve a rate better than 1.5, 1.45, or 1.42, then happy days. Their gross margins will be higher than 20%. But as long as they can put in place a risk management strategy to protect that level of 1.5, then they'll be achieving their goals of a 20% gross margin. Now, when it comes to a budget rate, there's a few key points to note. It firstly needs to allow for competitive pricing. A budget rate can't be at the point where pricing needs to be so high that the selling price may not be competitive. It must be achievable. So in this example here, if the importer was targeting a rate of 1.4 in the current market, that's below the current spot market rate. So that wouldn't be achievable or realistic. And lastly, it needs to be set for the period of fixed pricing. So a budget rate should be set for the same period where prices are fixed and cannot be changed to account for any FX fluctuations. So the next step with hedging is the how. How do our customers go about hedging? Our approach here at Western Union is to start via what we call an exposure visibility analysis. So after understanding your business needs, the exposure visibility can be used to easily demonstrate the currency cash flows and also where the risks are. Finding the gaps then allows you to have a more informed discussion rather than trying to guess or to predict the market. A hedging strategy is then easily tailored for your business needs, which allows us to become a trusted long-term partner for your foreign exchange risk management. And these are typically reviewed over time. And lastly, the what, the last step in the process. So I'd like to highlight here that choosing the right product should always come last. By understanding the business needs at the beginning, the most appropriate solution is always easily found. When it comes to the different options for hedging, and we'll go through some of these in more detail shortly, the most commonly used and straightforward hedging solution is that of a forward contract, which locks in an exchange rate in the future for an agreed amount. So forwards are a fantastic hedging tool for protection. The drawback, of course, is that there's no room for participation in favourable rate moves, as the rates are already 100% locked in. Options, on the other hand, are able to provide protection, participation in favourable exchange rate moves, and also enhanced rates with some products. There's no right or wrong product when it comes to hedging. It all comes down to what's most appropriate to protect and to add value to your business. So we'll now move on to different hedging strategies, and in particular how these can be incorporated to utilise market volatility. So going back to the how of hedging, putting in place a structured strategy is crucial. A lack of structure is a very costly mistake when it comes to hedging. In particular, when we see customers chasing the market, they may have had a view and didn't execute, but not having a structure in place can be very costly. A prudent hedging strategy should not be dictated by the market. Rather, the market should be used to assist in determining the most suitable product for hedging. So markets should never be dictating strategy, and that includes having a market view. So this is a real customer example that we've had at the start of this year, where this particular customer had a view that $SCCCI was going to trade down below 1.34. At the time in January, $SCCCI was trading below 135. We had been speaking to this customer about taking advantage of these low rates, given that their budgeted rate was up at 140. So they were already able to put in place a risk management strategy that would provide them with an extra 4% on top of their budgeted rate. So by achieving their budgeted rate, they've achieved their gross margin, but an extra 4% from putting in place a risk management strategy really should have been more of a straightforward decision rather than trying to wait for the next big figure on the downside. Well, we're now aware that 134 didn't ever trade this year in $SCCCI, and we spoke to the customer a couple of weeks later with an idea to protect below 137 with a participation opportunity down to 135. Now, once again, this customer was adamant that $SCCCI will turn back below 134, but as we can see from the chart here, that didn't happen. We had the MAS announcement in early February that they were keen to let the Singapore dollar weaken. After that happened, there was a spike in $SCCCI, and on a shallow pullback, this customer finally hedged reactively at 138.50. So they still achieved their budgeted rate. They were able to protect themselves more than 1% below their budgeted rate, but they did miss the opportunity to protect at significantly better levels, around 4% better than their budgeted rate. So this is a classic example of chasing the market as a result of having a market view. So markets should in fact help to decide product. They can be used to tailor a strategy. So as we're all aware, dollar SING is currently closer to the 12-month highs compared to what it was in January. Given how far we've moved up in the past 4 months, US dollar buyers, and we're seeing this with a lot of our customers, they may not want to lock in a rate near current spot levels. They still want to protect themselves, but a lot of them are now preferring a product that offers participation. So that means that something like a collar, and we'll go through details of a collar shortly, but this can provide the full protection, but also allow for participation down below current spot. Dollar sellers, on the other hand, may be very happy to sell at current spot levels, given how much we've moved up from early January. However, other dollar sellers may have a view that markets, beg your pardon, that the dollar will continue to move higher. So whilst they want to put a risk management strategy in place, they also might want some participation on the upside. So they could also utilize something like a collar that would allow for even further participation to the upside. So in terms of market views, I'd just like to address this briefly because many of us do have a market view, and it's important to note that there's absolutely nothing wrong with having a view on the foreign exchange market. It's good for everyone to keep in touch with what markets are doing. However, none of us have one of these. We don't have a crystal ball and know where the market's going. I'd like to share briefly my own experience. Prior to working for Western Union, I spent many years as a foreign currency trader with ANZ Bank, the Australian bank in Melbourne and London. And inside the dealing room, you have a lot more information on the foreign exchange flows from central banks, from some of the bigger customers. But even with all that information, it's impossible even for the best traders in the room, which certainly wasn't me, but there were some very good traders in the dealing rooms I worked in. They could never get the market right more than about 60% of the time. The best traders were always just the best risk managers. So whilst there's nothing wrong with having a view, any such view should be used to tailor a hedging strategy, as we've touched on previously, not to avoid a hedging strategy. Our most successful hedging customers are not those who have the most accurate market views, but rather those who have managed their foreign exchange risk most prudently. So I'll be going through another example shortly with regards to using the market to tailor a strategy. And this will involve two different products. So I'd just like to outline these two products briefly before I go through the example. So a forward contract or forward exchange contract, as they're also known, locks in a particular rate in the future for a predetermined amount. So in the example here, this is a contract for 3 months to buy $1 million US each month. We can see that the rate for each month is slightly different. This is due to the fact that the forward points for the dollar SING pair are negative. In the interest of time, I won't go into detail about why, but that's entirely due to the interest rate differential between the two currencies. So if we assume a market spot rate of 1.42, the 1 month forward rate is around current market spot. The 2 and 3 month rates are slightly below. What we frequently do for our customers as well who prefer a single rate is we can do an average rate, otherwise known as a par forward rate of 1.4198. So with this contract, you'd be protected at 1.4198. If spot goes much higher, 145, you're buying at 1.4198. On the flip side, if it goes lower, down to 138, you'd also be buying at 1.4198. That rate is locked in. So the benefits of a forward are it allows you to fix your exchange rate to protect against unfavorable rate moves if the market trades against you before the expiry. It's full protection. The risk, however, is due to the rate being fixed, there's no ability to participate in favourable rate moves if this does occur. A collar, on the other hand, does allow for participation. So if we assume the same spot rate, 142, what a collar does is it provides a protection rate where you are 100% protected, just like a forward. But we can see here the protection rate, 143.20, is higher, not as good as the forward protection rate, 141.98. There's also a participation rate for a collar at 141.50. So how the collar works is with this structure, you don't necessarily have to trade at the protection rate or the participation rate. If we consider at the end of 1 month, if spot finishes above 143.20, say at 145 or 150, then you are fully protected at 143.20. If spot finishes in between 143.20 and 141.50, so for example, if it stays around 1.42, then you just buy at spot. You're not obligated to buy at 143.20. So that's the key difference with a forward. In that with a forward, you're always obligated to buy at that rate. With a collar, you only buy at the protection rate if the market moves above that rate. If spot moves lower, say to 1.4 or 1.39, then you are obligated to buy at 1.415, but that's a better rate than the forward rate. So collars allow for participation in favourable rate moves. So obviously the benefit is protection at all times and also the ability to participate. The risks are that the participation is capped at the participation rate. So you may end up buying higher than market spot if it falls significantly. So we'll now go through another real client example that we experienced earlier this year. So this particular client was actually a seller of US dollars and they needed to sell US dollars to fund their operational expenditure in Singapore. Their budgeted rate, their target rate was 1.35 for the calendar year of 2020. So as long as they were selling their US dollars into Sing at 1.35 or higher, then they were achieving their budgeted rate. Now, when we spoke to them about putting in place a hedging strategy in January, market spot was at 135.80. The client was interested in participating in favourable rate moves, but only if the budgeted rate could still be protected. So we discussed two solutions for a 3-month hedge. They wanted to hedge on a quarterly basis. So the forward rate, using the forward contract, could protect at 135.40. That would mean no matter how low spot goes, they will be selling their US dollars into Singapore dollars at a rate of 1.3540. The collar pricing could only protect them down at 134.20, which was below their budget rate. The collar did allow them to participate, of course, up to 136.20, but it couldn't protect them above their budgeted rate. So the forward rate did provide them with a workable solution to achieve the budgeted rate, but the collar didn't. As a result, the client entered into a forward contract for 3 months for January, February, and March 2020 to sell US dollars at 135.40 every month. Now, a few months later, in March, dollar Sing had moved higher up to a level of 1.4. The customer approached us again to put in place a hedge for the months of April to June for the second quarter of the year. They were again interested in participation if their budget rate could still be protected. And we again discussed the same two solutions for a 3-month hedge. So the budgeted rate for this client hadn't changed. That was set for the calendar year at 135. The outcome was that the forward rate could protect at 139.60. The collar could protect slightly lower at 139.20, but both rates are still well above the budgeted rate. The collar could also allow the customer to participate up to a level of 140.50. So as a result, the client entered into the collar for 3 months for April, May, and June 2020 to sell US dollars being protected at 139.20 with the ability to participate up to 1.405. So this is a classic example of using the market to determine product. A lot of customers may have a desire to be able to participate rather than locking in a forward, for example, but if the participation solution can't achieve a goal of protecting a certain rate, then in that case, a forward would be a better solution like we saw in the previous slide. So where the market is trading is always important to take into consideration when it comes to choosing product. Now we do have over 30 different solutions in terms of our hedging products. Obviously, I'm not going to be going through all of these today, but I'd like to just highlight that these can be broadly broken down into three categories of protect, participate, and enhance. So the protect strategies or the protect products provide a guaranteed protection. There's no participation in favourable rate movements, and we saw that before with forwards. Participation products also provide guaranteed protection, and they do allow for participation in favourable rate moves. We saw that earlier with a collar. Enhanced products, on the other hand, provide enhanced rates, better rates than the forward rate, and in some cases better than the current spot rate. However, with an enhanced rate, although they do provide a very good rate to perhaps improve an average rate, there's always a risk of ending up with no protection, and there's often leverage involved as well. So I won't go into great detail with our enhanced products, but I'd like to just quickly outline a couple of examples. The first product that I'll briefly discuss is that of a target redemption forward. So if we assume that the spot market for dollar Sing is trading at 1.42, the target redemption forward can achieve an enhanced rate of around 139.80 off that spot rate. So obviously that's a very nice rate to be buying US dollars against current spot, more than 200 points better than the spot market. However, there's also a number of risks involved with this product. Firstly, this is a 12-month structure. So you are locked in for 12 months potentially. And there's also the risk of the protection not lasting for 12 months. So a target redemption forward has a certain number of points, FX points that are attached to it. Once these points are used up, the rest of the structure disappears. So the product, although it is a 12-month structure, it may not last for more than a few months. It is suitable for consistent monthly requirements, given it does need to be in place for the same amount every month for 12 months. So a lot of the time we see customers utilising this product in conjunction with something like a forward for the guaranteed protection in order to achieve an enhanced rate. But to achieve protection alone, the TARF isn't probably the most suitable product. Another enhanced product that is frequently utilised by customers seeking enhanced rates is that of a leverage knockout. So like the target redemption forward, a leverage knockout can provide a rate significantly below current spot market. To achieve a rate of around 139.90 when spot's trading at 142, a 12-month structure is required. However, a leverage knockout doesn't have to be a structure that long. The way a knockout works is that there's no protection if spot finishes higher than the knockout trigger at expiry. So with this pricing, there's a knockout trigger attached at 146.50. At the expiry date, if spot is higher than 146.50, then the protection's lost and you just have to buy at market spot. So although a very good rate is provided when the contracts is incepted, there is a risk that the protection will disappear. As opposed to a target redemption forward though, the knockout can be tailored to any tenor. It can be 1 month, it can be 6 or 12 months, and there can be any number of date. It can just be for a single date if preferred. So I won't go to any more detail on our enhanced products. However, I just wanted to outline at a very high level the types of products that are available within our suite. So in terms of the different hedging strategies that are commonly used by companies globally, these can be broadly broken down into 4 different categories. The first of that is what's known as a static or annual hedging strategy. With a static strategy, most hedges are placed annually, and typically it's to align to a longer budgeted or pricing cycle. A rolling hedge is where hedges are placed periodically, usually monthly, quarterly, or 6 monthly, to achieve a known rate for that period. As part of a rolling strategy, a lot of customers utilize what's known as layering, which is effectively averaging in to a hedge. So this involves hedging an increased amount over time to achieve an average rate. And in fact, rolling with layering is particularly important at the moment because it very much mitigates the risk of market timing. So in volatile markets, we typically do see layering utilised more than when markets are calm. And lastly, ad hoc hedging, hedging periodically is known as non-structured hedging. However, it can also be commonly used for project-based hedging. So companies with projects that they need to hedge, but they're not sure when projects are going to come in, then obviously they won't be able to use a static or a rolling hedge strategy. They instead just need to utilize an ad hoc strategy. So I'd now like to address a very interesting and widely known report in the FX industry that was compiled by Deloitte back in 2016. So they prepared a global foreign exchange survey of 133 multinationals globally. And it was found that 67% of respondents used a structured hedging strategy for their primary risk management strategy. So we can see the results here from this survey that approximately 1/3 of all respondents used a ad hoc strategy, but more than half of all respondents used a rolling hedge strategy, whether it be flat or layering. It's also interesting that only 8% of all respondents used a static or annual hedging strategy. So if we consolidate this in terms of structured and non-structured, it's obvious that most respondents, or 2/3 to be more exact, did adopt very much a structured hedging strategy, with the companies that adopted a non-structured strategy likely to be companies with more project-based requirements. In that report, it was interesting to see the breakdown by industry. So what we can see here, firstly, is that energy and resources, which is very much a project-based industry, predominantly used ad hoc hedging. Rolling hedges, both flat and layered, the green bars here, were used quite widely across all industries except energy and resources. And we can see as well that only financial services significantly used an annual hedging strategy. And that's likely due to those industries having annual pricing cycles. Now, although this survey was conducted for multinationals, not for SMEs, it's always a very good guide because typically multinationals have very structured and well-planned hedging through their internal treasury departments. So it's always interesting to take note of how their particular industries are approaching their hedging and their overall risk management for FX. So in summary, for risk management strategies, structure is absolutely crucial. We've seen that a lack of structure where customers can end up chasing the market can be very costly. A prudent strategy is essential to not let the markets result in you not having a risk management strategy in place. Instead, markets should be utilised to determine product, not to decide whether to hedge or not to hedge. With regards to market views, as we were saying earlier, there's no problem with having a market view, I beg your pardon. Market views can be used to tailor a hedging strategy and can also help to determine the most appropriate product. But the focus should always be on FX risk management, not on trying to outperform the market. And in terms of the hedging strategies that we saw in the Deloitte report, the three most commonly used are that of a rolling hedge, often utilising layering, which is very important in the current environment of heightened volatility, and also ad hoc hedging, which is used for companies more with project-based requirements. Ad hoc hedging, when you have known requirements, is typically seen as being very unstructured. So that concludes the formal part of the presentation. If you have any further questions, please feel free to type these via the Q&A icon below. I can see we've had a lot of questions come in already, and we will address these shortly.
Okay, sure. Thank you, Edward. Thank you for the presentation. I hope all the participants have more, ideas about how to go about hedging and, have a general outlook of like the market in general. So, but before we start off with the Q&A, okay, for those who would like to receive the presentation deck as mentioned in the chat group, please take some time to scan the QR code on the screen right now to fill up a short survey. And after you have completed the form, the presentation deck will be sent to you in a few days time later after editing is done. So without further ado, now let us welcome back our speaker, Edward. And together with us for today for the panel discussion, we also like to invite Ms. Michelle Mark, Head of Sales for Singapore and Malaysia from Western Union Business Solutions, and Mr. Louis Lee, Area Sales Singapore from Western Union Business Solutions for the Q&A session. So as usual, for any of the participants who have any questions, please click on the Q&A button below to type in your questions that you have for the speakers. But do bear with us because due to the limited number of time we have, and do note that this session will definitely be, will extend for about another 10 to 15 more minutes. So we seek your kind understanding that in a situation if we are not able to answer your questions, okay, for those who answer the Q&A as a non-anonymous, we will have your email records and we'll pass it off to Western Union to follow up with your Q&A questions if we are unable to answer them during this period. And for those who have other dying questions that maybe you do not want to post it up on the Q&A, please contact Western Union directly, or if you send us an email to SCCCI, we will also be able to follow up and forward it to Western Union. So looking at a list of Q&A questions, yes, we do have quite a lot of questions going on, okay? And maybe I'll just start off with the first one immediately jumping into it. Okay, so we do have one participant who have, an inquiry on, on the supply chain recovery, especially, with the current US-Sino trade wars going on, So Edward, maybe can you comment about, how do you think about, moving forward on the supply chain recovery, for the next couple of months, especially?
Yeah, sure. So that's definitely a very relevant question. We have seen supply chains disrupted significantly over the past few months. I've noticed that on a personal front. I can't buy my Australian broccoli in the supermarkets at the moment. So it's not just from China and the US. Globally, supply chains have been very disrupted. Now, with the trade war, obviously, that does disrupt some supply chains out of China, but the main disruption that we've seen over the past few months has predominantly been due to the global lockdowns and also less air freight as well. So once we see the reopenings of economies, provided we don't see a severe second wave of coronavirus, we're likely to see those supply chains recover, but definitely it will be more closely tied to the economy's reopening smoothly rather than the trade war tensions.
Okay, I hope that answers one of the participants, inquiry on, the supply chain recovery. Okay, now let us jump on to the next question, which I see a lot of participants are asking. I think it's also for Edward on the recovery of the economy. Different economies, some of them have said that it's going to be a U shape. You have voiced out maybe it's going to be a V shape. What about for the next couple of months, moving forward at the current situation, and maybe what are the things that the main factors that may continue to affect the economy at the moment?
Yeah, sure. So obviously a V-shaped recovery is being spoken about heavily, and that's natural given how quickly growth and global stock markets fell off a cliff. It's never happened before, and for the same reasons that it fell off so quickly, it's plausible that it could rally just as quickly. However, as we alluded to during the presentation, there are a number of risks to this recovery. So first and foremost, how smooth will these economies reopening turn out? So a second wave of coronavirus could disrupt the economy's reopening. Some governments will be more inclined to impose a second lockdown than others. As well as that, consumer spending may not recover as quickly as many people are thinking. So it's a great unknown how consumers are going to spend, even if the economies are reopened smoothly. None of us have ever been through anything like this before. And so definitely our behaviours and spending patterns are a big risk. More recently, and this somewhat relates to the previous question, we've seen more tit for tat between Trump and China. He's blaming them heavily for the coronavirus outbreak. Obviously, China haven't been too pleased about that. They've threatened to walk away from the phase 1 trade deal. Trump's threatened more tariffs. So that's another key risk to a V-shaped recovery. This is probably the worst time that we could see tensions reignited. So if one or more of those risks became serious and developed into what's being feared, then we could indeed see more of a U-shaped or a swoosh recovery as well.
Okay, I hope that answers many of the participants' inquiry on the economic outlook. I think there's still a lot of risk factor for consideration moving forward. Okay, I do have another participant is asking on the yen. You know, yen, as you mentioned, is a safe haven currency during crisis. But they felt that yen is really being badly affected, especially during this period. So how is yen a safe haven currency, especially during this period?
Yeah, that's a good question. So in terms of the safe havens, it goes back for many years with the yen and the Swiss franc in particular, also for the US dollar, that those currencies aren't tied necessarily to how their economy is performing. So the Japan economy has been in a state of deflation and very slow growth for decades now. However, the low yielding currencies such as the yen and the Swiss franc are always supported during times of economic downturn. The reason for that, during growth periods when investors are more, there's a high level of being able to take risk on environment, stock markets are going well. But in those times, people or investors in general don't want to invest in the yen. They don't want to invest in Swiss franc because they'll achieve negative interest rates. So they instead invest in Australian dollars, in emerging markets currencies, and achieve a much better yield. But when there's times of economic uncertainty, everything gets unwound. So stock markets get sold off. The positions in these emerging markets and Australian dollar currencies get sold off. No one cares about the yield anymore. They just want to cut their positions and park it back to low yielding currencies where they believe it's safe. So for that reason, despite the Japanese economy and also the Swiss economy is not doing well either, but those currencies, just by nature of the fact that investors know that those currencies will remain strong during the crisis, that they're always going to be seen as safe havens, irrespective of how their domestic economies are performing.
Okay, Ken, sure. Thank you, Edward. Thanks for the answering of the yen questions. Okay, I do see that I have quite a number of them asking about your opinion on Aussie dollars versus over to Singapore dollars, or what's your outlook of Singapore to Aussie dollars, especially in the next couple of months moving forward, because I know Aussie dollars has dropped quite significantly versus Singapore dollars. So what's your view? Especially I noticed that in your presentation slide, if the market is moving better, Aussie dollars will strengthen up. So maybe you can help some of the participants to answer it.
Yeah, so the Aussie Sing is going to be very much tied to what type of recovery we see. So if we do see a V-shaped recovery, then very likely we'll see the Aussie Sing pair strengthening further. We did see in late March it was quite unbelievable that the Aussie Sing dipped below 80 cents. That was obviously a very good opportunity to buy Australian dollars. But if we don't see this V-shaped recovery, if instead we see a long U-shaped recovery or a swoosh recovery, as we spoke about earlier, it's likely that the Aussie Sing will weaken further, because the Australian dollar is much more of a high yielding currency historically than the Singapore dollar. So if we get the V-shaped recovery, I'd say it will be well supported and possibly higher, but any other type of slower recovery, it will likely head back towards 90 cents or possibly lower.
Okay, Ken, sure. Thanks, Edward. I hope that's answered some of the participants on their inquiries on Australian dollar. Next up, I do have someone, saying that, for FX is closely linked to price of crude oil. So do you think that oil will still hover around USD $20 per barrel, or, what's your view on the next couple of months for, oil itself?
Yeah, so oil's been in, I guess, unprecedented territory over the past couple of months. I'm sure many of us saw that last month we had the unbelievable situation where oil prices turned negative for a couple of days. And that was due to the fact that there's no demand for oil at the moment. There's very few planes flying. With the lockdowns, people can't drive much. And with no demand for oil, the global supplies were getting full. There was literally nowhere to store it. And with that fear, the oil producers who can't just shut down their plants, shutting down an oil plant takes several months. So they were still producing millions of barrels a day that couldn't really be stored anywhere. And that's why they had to pay to have the oil taken off their hands. Now, oil's since recovered to, I believe, above $30 a barrel currently. And that's in anticipation of economies being reopened and demand for oil with more driving, possibly a bit more flying, happening over the next few months. But the oil price will probably be less linked to foreign exchange at the moment. Typically, there's a negative correlation between the US dollar and oil. So a stronger US dollar means a lower oil price and vice versa. But in the coming months, I think oil will be very dependent on how much of the economies are being reopened. So if the reopenings go smoothly, we would expect to see oil prices possibly move a bit higher. If we see a second wave of coronavirus and economies have to be shut down again, even partially, then that will have a quick negative impact on oil as well.
Okay, Ken, sure. Thanks, Edward. I think a lot of things still depends on the next couple of months, especially with the coronavirus, how it moves forward down there. Okay, I will, shift the question to Louis, because I can see that Louis is able to answer one of the question by one of the participants on the participation down to 1.35 million. Okay, I think it's referring to the hedging presentation on the hedging area. What does it mean by for the USD where the participation down to 1.35? So I guess, Louis, you would like to answer that question on it?
Yes, so actually just want to share with the participant that essentially Edward has ran through at the end of the few examples in terms from the participation. So what it allows is that the contract allows participation for the market to a certain level, in this case, for example, 1.35, and also up to the that will be for the protection rate itself.
Okay, Ken, sure. Thanks, Louis. Since we are on this hedging, topic, I also like to continue the questions. So some of them are asking, like, is there a minimum sum, that they have to put in or exchange for the forward exchange contract, and is there a minimum sum for also the collar strategy that you guys have mentioned? And I also have questions on, is there like any administrative fees, everything? So probably maybe I have Michelle Louis to talk further in details about this, hedging, some of the admin fees moving forward, and the minimum that maybe companies should take note of before, for them to hedge on it. Yep.
Right. Thanks, Tiffany. So we offer a wide range of products, from the protection to the participation to enhancement products. typically there are no admin fees for the products per se. So what we do is really want to understand your requirements, your exposure, where do you want to look for in terms of protection or participation, and then work out with you what are your monthly requirements, then which are the strategies that would be beneficial for you, because every client, every company is different. And so for that, really there's no fees. In terms of minimum, it really also depends on your exposure per month. We sometimes also encourage clients, they may not want to cover the entire of their exposure because market moves, and in terms of timeline tenor as well. So we actually provide bespoke or customized solutions for each company as well. So of course, if the amount is too small, like for example, your exposure is only like 20K per month, then maybe you might not want to go into some of these hedging solutions because fluctuations in the market may not affect you as much as say if you have a 200K exposure per month, right? Yeah. Edward, would you like to add on to that? Yeah.
Yeah, sure. So with hedging, we typically don't talk about 100% covering of requirement, just because often customers like to leave at least some open to the spot market, and also requirements can change over time. Now, in the current environment, requirements have changed drastically. It's completely different, but even during more normal times, we'd prefer to stick to somewhere around the level of 80 to 90% at a maximum, just to allow for some buffer in case something unexpected happens.
Okay, Ken, sure. Thanks, Edward. Thanks, Michelle. Michelle, just to top up a bit, because one of the participants is also asking, so that at least our participants will have a sense, whether to approach you guys. Understand that, you have mentioned, like, if yours is just 20K, maybe, you don't really need to hedge it. But one of the participants is asking, like, how much should their annual revenue or exchange that they have to utilize per year before it makes sense to use such contracts or options for hedging? I understand that each different company and industry has different requirements going on, but maybe you can just give a ballpark figure, like what kind of company size of revenue, or to what extent they should start thinking that, hey, I need to start hedging already because I have how much amount of overseas forex currency exposure. So maybe you can give the participants a figure to it.
Yeah, sure. Thanks, Tiffany. When I say they may not want to do hedging like the more complex products, we do offer other solutions like overnight orders, which may also help them to get better than spot rates. So there are various ways that we can help SMEs of different sizes. So do ping us after this to have a more in-depth chat with us on how we can assist you, especially in the current state of all the fluctuations in the market. Yeah. So in terms of a minimum, really, it's very hard to if you say how much of the exposure a year and so on. I think where would be comfortable probably would be about 100K a month at least. Edward, would you say that's something that we usually come across? Yeah.
Yeah, typically, that's right, Michelle. Most clients would be looking at a minimum to hedge around 100,000 a month. But in saying that, we do have clients that hedge less. They might be hedging 50,000 a month or 40,000 a month. I think it also comes down to the pain points. So even if your amounts are only 40 or 50,000 a month, if a 5% fluctuation in the exchange rate is going to cause I guess some emotional pain, or the bottom line will be impacted to a level that you're not comfortable with, then please approach us, in particular Michelle's team, to be able to discuss ways to mitigate those risks.
Yeah, indeed. Yeah, I think Edward pointed out a very pertinent point. Is really not so much about the minimum amount per se, but how has the fluctuation market affected you. And so if a 5% move in the market really if your profit margins are very tight to begin with, and taking out a protection product helps to mitigate that risk and protect your profit margins, then I think it's also something that we are happy to assist you with. Yeah. For certain products, maybe for you to reap more benefits, then the premium amount may need to be higher. Yeah.
Okay, can share. Thanks, Michelle. I think you know, for participants who are interested, you guys can contact Western Union directly, because each and individual companies has different needs. So that, you know, Western Union can analyze, you know, what kind of needs their company can to provide you with the best product and solutions. Now, moving forward, I do have a lot of companies. I think they are dealing with China, you know, renminbi in general. So they want to know, like, you know, do you guys help in hedging USD to renminbi, and, you know, do you guys do it? And, you know, what are some of the hedging risks, you know, that they have to take note of, you know, after you guys saying that, okay, there's no cost, you know, but, you know, what are some of the hedging risks, you know, moving forward also?
So in terms of hedging for the Chinese currency, we can hedge CNH, not CNY. So to make that clear, we can utilise not only forwards, but the option structures for CNH. But for CNY, we're not able to hedge.
Okay, Kensha, I hear from you. So for participants who are asking about CNY, I think that gets your answer with it already. Okay, and you know, moving forward, I do have still quite a number of questions. I think it's more for Edward, or many on USD. I'm going to one-shot answer quite a few of them. Many of them is asking about what's your view on, like, you know, euro dollars, pounds, you know, against USD, and USD to yen in general. So I think mainly is the focus on USD rate. What is your view in the upcoming 12 months, you know, of USD? Is it going to be strengthening, or is it going to be a drop, and versus some of the popular currencies such as the euro dollars and yen dollars?
Yeah, so our house view, and this isn't my personal view, this is the view of our APAC currency strategist who's based in Melbourne. His view is that the US dollar will remain well supported over the next 12 months. He thinks those risks that we've discussed during the presentation and also during this question time should not be ignored, and we'd only need one of those risks to eventuate to see the stock market have another leg lower, in which case there will be a flight to safety as we saw in March and the better part of April. So his view is that the US dollar will be strengthening against both the euro and the pound, and that the yen will in fact be strengthening against the US dollar, because whilst the US dollar is a safe haven currency, the yen is even more so. It's probably the #1 safe haven currency.
Okay, Kensha, thanks, Edward. Okay, we've really exceeded our time a lot. Maybe I'll just pick up the last you know, question that, you know, since a lot of participants are asking about the USD, this will be the last question. For those who still have questions that we have not answered, probably you can just email Western Union directly. But the last question we do have is that, you know, if I am a US dollar buyer and the rates are too high at the current moment, you know, so do you recommend, you know, for participants like them, you know, to start hedging USD dollar since the rate is really so high? Do they start hedging it, or, you know, should they wait for some time before US dollar goes down, or what is your recommendation for them?
Yeah, that's a good question, and it ties into a number of items that we addressed throughout the presentation. So firstly, where the market is it should help tailor a strategy. It shouldn't help to decide whether to hedge or not to hedge. I personally don't believe there's ever a bad time to hedge, but obviously where the market's been and where it is at the moment is definitely a consideration. So a US dollar buyer who feels that rates are too high at the moment may want to consider something other than a forward. Obviously a forward just locks in the current rate, and if spot does move lower, then they don't have any scope to participate. So they do have the option of a participate product if they want to still protect. They do have the option of an enhanced product, but that wouldn't be an appropriate solution if they're looking for protection. It's important to also note that, as we highlighted during the presentation, that during the global financial crisis, dollar Sing actually reached higher than 156. So it's come up a long way so far. I believe it's around 140, 160 at the moment, but it could possibly go a long way further if one of those risks eventuates. So considering hedging with something other than a forward would be something that may be appropriate for those US dollar buyers.
Okay, thanks, Edward. Thanks for the valuable, information about how they should, companies should move forward, especially those with high risk of forex exchange exposure. Now we've come to the end of the participation for today's webinar session. As for those participants who is using your mobile phone, you probably have issues on scanning the QR code. Rest assured that after the event, Singapore Chinese Chamber will be sending you the email on how to retrieve your presentation deck. Do note that do give Western Union a couple of days to edit the slides before sending it to you. And for those who have any other inquiries, please email Western Union directly, or you can just drop SCCCI email and we will also forward it to them. So moving forward, I'd like to thank Edward, thanks Michelle and Louis for today's participation of this webinar session. And I hope that participants have gained a lot of information from today's session on what's the next couple of months outlook, and especially on the forex currency and how to hedge their funds moving forward. So thank you so much for today's session. We hope to see you in future SCCCI events. Thank you, everyone. Thank you.
Thank you.
Thank you.
Thank you, everyone.